Good afternoon. If I can ask everybody to take their seat, we are about to begin. Zach, Margaret, you in front. Everybody is in. Is there anybody else coming? Good afternoon, everybody. Thank you to the people in the room. I'm welcoming everybody in person. We also have a number of people online, so welcome to everybody online. This is our third in-person AGM. In fact, it's almost to the day or the week that we did this 2 years ago. And why I remember that, because I was chatting to Deborah earlier, and we did the last one during the art fair, the Cape Town Art Fair as well. So welcome. A lot of you have traveled long distances. We really appreciate you coming out, flying, some of you over 11,000 kilometers to be with us at Launch Africa. So today we are going to run through our very formal session of the week, which is our AGM, giving you a snapshot of the performance of the funds. Tomorrow we're doing something a bit more social, which is engaging with the ecosystem, but specifically with our founders. They will be doing pitches, you'll have some speed dating sessions with them, and we're doing some panels. And then Friday, we take off our jackets and we relax a bit with some food, wine, and some activities in the morning. So welcome, everybody. So some logistics. The bathrooms are to my left, your right, just over there. And there will be drinks and refreshments after this first Fund 1 session. We ask everybody to post your questions on Slido, which is this QR code. For the people in the room, there's also a link that you can now click. If you have any questions during the session, please post them on Slido, and our operations manager, Florence, will be managing that and asking those questions at the end during the Q&A session. So if you're online, please click the link. If you're in the room, please do a scan of the Slido. Our agenda today is really about taking you through the journey of the last 2 years since we did our AGM. And it's really been a difficult 2 years. Globally, there's been an economic downturn. We all thought that interest rates would come down. It's slowly moving in that direction. And then the world changed, right? We're living in very uncertain times at the moment, both politically, but also economically. And that's really been reflected in the journey of global VC, but also specifically in Africa. We always say that when the world sneezes, Africa has a cold, and we've certainly seen some of that capital drought happening. And we'll walk you through a journey today of the theme for us in Fund 1 has been one of surviving, but at the same time thriving. And as you engage with us, those are the two things that I think is continually highlighted in our conversations, in our interactions with our investors, but also our founders, is how do you survive during an economic downturn while at the same time building for the future so that you can thrive. We've seen capital really dry up, and if you just look at the biggest funders in Africa, not Launch Africa because we're predominantly retail, but if you look at other funds that are DFI dependent, a lot of them have not had any capital investments. In fact, most of the European DFIs today are not investing in Africa at all. Zach and I attended Super Returns in December, and we heard all European DFIs have taken their money and investing in the Ukraine. And so today's discussion is all about how do you continue to exist, add value to a portfolio, and exit during a capital drought. But our big focus is really around exits. And the majority of our presentation today will be focused on what is our strategy around exits. And we would love you over the next 3 days to engage with us actively so that we can pick your brain on our methodology of exits, but also you telling us how you see this market going. We are constantly balancing this thing around having a nice IRR. For a fund manager, that's important. But because our fund is predominantly retail investors, liquidity is also important to us. And in our world, we call it DPI. That's the return, the physical cash in your bank that we want to return to you. We're 5 years old now, and we have started with our exit process, as both Zach and Kartik will take you through today. But we're also so focused on returning capital to you. And again, as you listen and engage with us, please engage us on how you see your own personal investment wanting to be balanced between our fund performance and what you want to see in terms of returns. Then finally, we'll end off, what does the next journey look like for us, the way forward? And we are positive that we are seeing green shoots in this industry in Africa. In 2025, there's been more capital available invested than 2024. And what should we do as a leading Pan-African VC in order to drive this ecosystem? Because a lot of the ecosystem depends on what Launch Africa does and how Launch Africa innovate so that they can follow. That's just the power of our brand that we have. So I want to welcome you. It's going to be an interesting 3 days. Our team has worked really hard, and I want to thank every one of the Launch Africa team members who has tirelessly worked on putting this together. It's 3 days designed for you, so please engage, please attend the sessions, and please have a conversation with all the Launch Africa staff members, because the more they engage with you, the better they understand what your needs are, and the better they can translate that to the founders who are their biggest customers. I'm going to now stop talking and hand over to our board chair lady, Margaret O'Connor.
I am Margaret O'Connor. Warm welcome to everyone in the room and to everyone online. Launch Africa wouldn't exist without your capital and your commitment to helping to grow the African VC ecosystem and to help us build market-leading African tech-enabled companies. The management team's going to do a deep dive on the fund performance. I'm going to just take a step back and help to frame how the African VC ecosystem development compares to what we've seen in markets around the world, starting with the US. And for me, this is not an academic exercise, it's my lived experience. So in 1997, MasterCard sent me from New York to Silicon Valley to meet with Peter Thiel and Max Levchuk to figure out what are we going to do to contain these payment revolutionaries. Right? MasterCard was really worried about the banks being disintermediated. We didn't have the word fintech at that time. And these two lost no time in saying, look, we're not interested in MasterCard investment capital right now, nor do we need those distribution partnerships. But we'd really like you to be employee number 10. So that was quite an interesting compliment. It wasn't the right offer for me, but when I went back to corporate, I'm like, okay, sayonara, and set up an ad tech company with people I knew and trusted who were service providers to MasterCard. And we together built a company, a market-leading company in the US, Europe, and Asia in the late 90s and the early noughties. So when I moved to South Africa after helping to execute a successful trade sale, I was all revved up about like, okay, the final frontier market, how do we take what we've learned from VC ecosystem development around the world to this continent? I was ahead of the market. So eventually, 10, 15 years ago, when VC started to build out quite formally, we could see that there was a lot of parallels between what happened in the other markets. And I guess I've followed India most closely and had the experience of Europe. And so just like a couple of like financial bullet points. In this early generation of VC ecosystem development, you typically see the first two funds between $20 and $50 million. Small tickets, a lot of the companies taking 10 to 12 years to mature and to realize full value in a trade sale. The trade sale profile is often to banks, insurance companies, telcos, FMCG, largely domestic and sometimes big international tech companies. So that's what we're seeing in Africa. And there's been some frustration because obviously we live in a very globally connected world. And Africans, we want the system to grow up quickly, but it takes time. And as many of you know, we've invested in a lot of first-time entrepreneurs. And so Junaid was saying earlier about how do we work with you LPs to help add value to our companies. Part of what you can do is, of course, the mentoring. And some of you, in addition to co-investment, are serving on advisory boards. And we're very grateful for that. And we encourage those of you who have capacity to participate in that way to do so. We're very available. One of the things I want to talk about is the community as a unique value proposition at Launch Africa. So it's both the community of founders and the community of investors. So we at Launch Africa now have more than 250 professionals in our community of founders. And we're working to leverage that community of founders to share with them what we've learned over the last 2 years in terms of creating DPI. Right, so Launch Africa is ahead of India and other VC ecosystems at this early stage of development and starting to create realizations. And this is, we didn't see this in India at this stage in its development, but it's hard work. It's really hard work. And Kartik and Zach will share some more of the war stories. But what I wanted to share with you is the empathy that's required. Right, these first-time founders, when they put so much trust in Launch Africa has provided so much formal post-investment support. When we say, look, we have a retail investor base, we need to return capital to our investors, it's time for us to find the right investor, follow-up investor with the right capital stack and the right access to markets to help you grow. So it's painful parting, but we're very invested in their success. As chairperson, I couldn't not take a moment to reflect on the governance frameworks we've built at Launch Africa. So I think most timely and topical is the investment committee has become the exit committee. And we have 3 independent professionals in that committee that really help to interrogate the exit valuations and to ensure there's no conflict of interest. The other governance note is in 2025, there was an announcement of Junaid created the GEAR framework. So this is an initiative to try and ensure that entrepreneurs across the continent, including those from Tier 2 and Tier 3 markets, have access to training about governance, ethics, accountability, and risk management. We're really excited about the potential for this to enable many more people to access the entrepreneurial community. I'm going to hand over now to Zach to take us forward, but really thank you so much for your participation, and I look forward to hearing more about what you guys want out of Launch Africa in the days to come.
Thank you, Margaret, and a warm welcome to all of you attending in person, and for those of you that are joining in online. From a market perspective, so when I first came to this beautiful continent of Africa 15 years ago, the word venture capital didn't exist. In my previous career, I was the founder of 2 of the biggest accelerators in Africa, Tech Lab Africa, which is now Techstars, and Startup Bootcamp. In 2015, so about 10 years ago, the entire continent of Africa had about $50 million of venture capital. And if you rewind 2 years ago, which was arguably the height of the venture ecosystem globally, venture capital in Africa reached 5 billion from an equity perspective. So it went from 50 million to 5 billion in about 7 years. And that acceleration, although starting from a low base, was the fastest in the history of VC, including the US. So to Margaret's point earlier about the fact that Africa is probably where the US was in the 1970s, where Israel was in the 80s, and where India was in the early 2000s, is something that a lot of investors are now trying to get the grips, to get a grip around. And what we've seen is, despite the last 2 years of, I would say, pessimism in the ecosystem, we've seen, for the most part, a bottoming out of the amount of smart capital getting into the African tech ecosystem. So this year, as in 2025, we saw $3.2 billion of equity enter the African tech ecosystem, which was higher than both 2024 and 2023. What's really interesting is, I'm going to point out 2 or 3 things. One is, in the early days of the VC ecosystem in Africa, the vast majority of capital was either going into accelerators and very early seed stage companies, and then selectively a lot of global funds backing B and C and Series D companies. What you've seen now is, of the 500 startups, 500 plus startups last year that raised venture funding, which is $100,000 or more, so starting from pre-seed to seed, almost a half of them raised a follow-on round of funding, either a seed extension or a Series A, for more than $1 million. This has never happened in Africa before, right? Half of all the raises had extensions within a year, right? $1 million is usually a benchmark for a decent follow-on round. And almost 70 of those companies raised a Series B, as in $10 million or more. Again, something you hadn't seen in the 2 years post-COVID. And a small subsection of them went ahead and raised Series C and Series D rounds, so more than $100 million. And the quality of that capital has shifted from what used to be just international funds dipping their toes in Africa, so typically American, Western European, and Asian funds, to now a point last year where African VC funds accounted for almost 50% of all VC funding on the continent, which is a clear indicator of the maturity of an ecosystem. For those of you that have spent time looking at the VC ecosystem in India, which is about 12 to 13 years ahead of Africa, most of India's early unicorns were backed by US and European funds. And the second half of that journey, a lot of domestic capital almost replaced international capital. And you're seeing that now for the first time in Africa last year, which is a very good sign for the future. In addition to just equity, we've had the rise of venture debt, revenue-based financing, and alternative sources of capital, where founders, as Margaret mentioned earlier, have matured in understanding the most optimal type of capital stack for what they require to grow their businesses. So whereas when we started Launch Africa 5 years ago, founders, mostly first-time founders, would use equity to fund everything from tech to product to team to marketing to even things like working capital and assets, which is a complete asset liability mismatch. Now you're seeing a lot of second-time founders and first-time founders that have gone through accelerators understand that venture debt and revenue-based financing is more appropriate, lower cost of capital, but also prevents too much founder dilution going forward. So consistently for the last 3 years, there's been between $1 and $1.5 billion of venture debt flowing into African tech startups, which takes away the huge amount of pressure that us as VC funds and similar VC funds have in equity funding for the same stage, region, and sector. A lot of people love to talk about unicorns. We're not big believers that unicorns are the only barometers of an ecosystem's success. But because the metrics are pretty standard, $1 billion valuation within a certain period of time, if you look at the history of Africa's billion-dollar companies, Africa's first billion-dollar company was Jumia, which listed on the NYSE in 2016, followed by 10 unicorns in just the last 5 years. So we're sitting at 15 unicorns today. But what's really interesting is that these unicorns have gotten to unicorn status a lot quicker than their counterparts in India, in the rest of Asia, and in the US. The average time it takes for an African startup to get from inception, day one, to $1 billion valuation, even though we're dealing with a 15-company sample size, is around 3 to 5 years. Even the US doesn't have those numbers. So yes, we're working with small sample sizes, but the trends are definitely positive. We had 2 unicorns last year, one a digital bank in South Africa called Time Bank, and you'll have the pleasure of meeting the Chief Commercial Officer of Time Bank tomorrow, as well as MoneyPoint, a POS platform in Nigeria. And last but not least, a lot of people ask us about what's happening with IPOs and listings. Well, the question is, IPOs and listings have been pretty bleak all over the world. But for the very first time, we saw 2 marquee IPOs on the African continent, both of them in Q4. You may be familiar with a company called Optasia, a fintech that does digital lending for SMEs in South Africa. They listed on the JSE, the Johannesburg Exchange, for $1.4 billion, which is one of the biggest IPOs in the African tech space. And all the way up north in Casablanca in Morocco, a fintech called Cash Plus listing for just over $500 million. So definitely some green shoots where the vast majority of liquidity and exits tend to be M&A and trade sales. We've now seen 2 marquee IPOs and a lot of founders that are currently at Series C and Series D that would not have necessarily considered an IPO path are now talking to pension funds and mutual funds about a potential IPO path. And we'll get to that a bit later. And just a final note here, in terms of in terms of the ecosystem from a geography perspective, Nigeria, South Africa, Egypt, and Kenya still continue to be the 4 dominant markets, accounting for just over 75% of VC activity. But you are seeing a lot of interest in Francophone Africa, so Senegal, Cote d'Ivoire, Morocco, Tunisia, and the rest of North Africa, ex-Egypt. And we'll talk about that a bit later in the presentation. To some actual numbers on how we've performed in Fund 1. So for those of you that have been with us since the very beginning, as a reminder, we had our first close in Q4 of 2020. We had our final close of Fund 1 in March 2022. So it's been just over 4 years, well, just under 4 years since our final close. We looked at more than 5,000 companies over that 3-year investment period. We invested in 133. So we deployed $31.1 million into 133 companies, and we're now in year 5 of Fund 1. On a mark-to-market basis, our Fund 1 portfolio is currently sitting at $48.8 million. And just to add a little bit more color on this, the way we mark our companies to market is different from the NAV statements you would have received. In the venture capital ecosystem, IFRS does not allow us to recognize companies that have raised safes or convertible notes at higher caps. They have to be kept at cost. So from a pure IFRS perspective, a lot of our companies have to be held at cost. In the last 5 years, we've written down 22 companies. That includes companies that have either shut down or are operating as zombie companies or dormant companies. We've conservatively marked those down to 0, even though they have some trading. 83% of all our companies after 5 years are still operationally active. And if you were to talk to any fund manager, those numbers are certainly above what you'd expect in even more mature markets. Of those 83%, more than two-thirds of those companies are trading at a premium to book. And that is where the bulk of our returns come from. So we're looking at a 1.6x MOIC, a 1.4x DVPI, and 3% DPI, which I'll come to a bit later. Exits. We've got an entire section on exits that Karthik, our head of exits, will speak about. But from a high-level perspective, some of the biggest lessons we've learned is doing exits primarily through secondaries when you're looking at getting liquidity in years 3, 4, and 5, which is quite rare for any venture fund in the world, takes a lot more time, energy, and resources in negotiating, and legal and administrative blockages than we could have expected. So while the average time it takes to do a diligence and investment into a company could be between 6 to 8 weeks, the reality that we've learned through the last 5 years, and the last 2 especially, is that it can sometimes take 6 to 8 months to exit a company, and this is important, even after terms have been agreed to between buyer and seller. And there are lots of reasons why it takes a lot. It's because of legal things that Karthik will cover in his slides. But it's been very good lessons and learnings for us, and we're very proud to say that our fund is one of the only funds on the African continent, at least, that has a dedicated full-time team just working on exits. And we have more exits as a function of our portfolio size than any fund that we're aware of. So, what have we done so far? We've sold 13 companies. 8 of them have been stock exits and 5 have been cash exits, a mix of partial exits and full exits. We sequence our portfolio into 5 quintiles. The top quintile of companies are companies that are currently marked and trading at 5x or more. And these are on actual priced rounds. These are companies that we have no urgency to sell right now because we'll be selling out of desperation. And these are companies that easily, within the next 2 years, could return 1x the fund. What we're focused on right now is the second quintile of companies that are trading at between 2x and 5x. And we're selectively looking at partial exits to full exits for them. And that's shown by the actual results we've had. Of the 5 exits we've done so far, totaling $1.4 million, the average MOIC is 1.4x, and that's net of all dilution and discounts. And our pipeline for the first half of this year is 10 to 12 companies. These are deals that have been signed, heads of terms agreement, and we're pending legals and final tax and administrative matters. The average MOIC on those 10 to 12 exits is 2.6x. And we're seeing higher MOICs as we move forward. And the last point before I head over to Karthik after this is the first distribution to our LPs, to all of you here, is expected to happen by the end of March. It's taken a bit longer than expected because of some of the legal challenges we've had as a fund, but we expect to return between 7 to 10% of capital before the end of year 5, which would be the end of our 5th financial year. Just very quickly, our top performing companies, which is the quintile 5 I spoke about, sorry, quintile 1 I spoke about earlier, that should get to 1x DPI, just that quintile alone. Very good mix between East Africa, West Africa, South Africa, and North Africa, and a good balance of sectors. I'll touch upon a few of them. Yobante Express is the leading last-mile delivery aggregator for logistics all over West Africa. We came in with a relatively small investment of $150,000 4 years ago. The company is currently preparing for a pretty big Series A, and the last traded price is at a 17x multiple to where we are. So the $2.6 million mark to market is a conservative estimate. We expect it to be at least 2 times higher than that. AfriX, a stablecoin remittance company based in Nigeria that does cross-border transfers between the US, Europe, and Africa. The other extreme, they are a Series B stage company. Their Series A was led by Sequoia. They're trading at a $100 million valuation, and we expect to make the same proceeds from that investment as we do for a company that's worth half as much. So one key takeaway I want to leave all of you with is, in the VC industry, it's not about how late stage a company is or how big its valuation is. It's about how much you own of that company. The diametrically opposite spectrum is a company called Strove that one of our LPs has done a very big co-investment into. Strove, we were the very first investors in there, a digital wellness and health tech company, where we invested $200,000 at a $1.2 million valuation 4.5 years ago. The company has not done its Series A round yet, and we already have the possibility to make close to $2 million if we were to exit them. So it's important. I want to leave you guys with this concept of understanding as a team how we balance waiting for companies to grow and get to Series B, Series C, and getting liquidity off of companies where we have a larger stake in, before they mature. I'll quickly round up here, and we're short on time. Peach Payments is an example of one of our Quintile 1 companies, the leading or the second largest payments aggregator in South Africa, Gateway. They're now live in 9 African countries. We are very close to finalizing an entire sale of our stake in Peach Payments to a large private equity fund, 2 large private equity funds, making a 4.6x net of all dilution. Similarly, companies in Nigeria. So it's a very broad spectrum of companies that will ultimately get to an at least 1x return of our capital. And it's a question of how we time this subtle balance between DPI and IRR that Junaid mentioned earlier. I'm now going to hand over to Karthik, our head of exits. Truly one of the only funds that has an actual head of exits in its team. So please, Karthik, take it away. Thank you.
Awesome. Thank you, Zach. So first of all, I think it's interesting to look at where we are in the life cycle of the fund. So as Zach said, at the end of this Q4 this year, we will have completed year 5. And so really the focus over 2025 had been, I will let you all take pictures, has been some of these liquidity exits and the early liquidity exits, balancing liquidity and MOIC. And so as you'll see in the next 2 slides, most of our returns on these exits have been in that range, but we're already starting to see some of those optimum kind of exits coming, and we expect a lot of work to go into, a lot of time and resources into those larger positions in the fund. And you'll see that we've already started work on actually 2 of them and realizing the return on some of these larger positions that can be slightly more complicated to sell than the smaller ones. Some of our LPs will remember from our last AGM, we said that we had about $4 million in pipeline that we were planning to execute on for the rest of the year. And really, through the next couple of minutes here, I'll show you how we've executed that strategy, put that into place, used a lot of our resources, such as the safe purchase agreement, which we developed about 1.5 years ago, in over half of our exits. So maybe first we should just review some of the work that we had done in the last AGM on exit mechanisms, because this will play into the rest of the presentation. So the 5 core exit mechanisms really are the sale of our shares to incoming investors. And this has really been the bulk of where we have received most of our liquidity. And in fact, we were expecting 1 LP with whom we had used the Launch Africa Safe Purchase Agreement, just to show you how truly efficient the process can be. Those exits are a lot faster for us. And you'll see a lot of our exits in the next slide come from using that mechanism. The second one is securitized asset sales. And we've started to see a lot of this develop now with secondary funds coming to the market and looking to do transactions. And so last year, a lot of our time and resources went into packaging transactions for this type of institutional investor. And in fact, Villani, who's in the room here with Lula, actually went through the process with us, where essentially we packaged a blend of primary and secondary investment in which we as a firm, as well as some of our co-investors, would have sold our shares part of a larger transaction. And we had done this with 3 companies. So a lot of work had kind of gone into packaging and preparing that transaction so that it was effectively ready for them to transact on and to deploy and to capitalize a vehicle that would provide that exit for us. An example of this is with Blue Earth Capital. We had done that work with Blue Earth. The third one is the company sale to a scale-up. So we continue to develop a lot of relationships with the top scale-up. So whoever has raised a lot of money might be a potential acquirer of either one of our businesses, or even a percentage of what we may own in certain business. So we continue to cultivate those relationships and facilitate introductions where companies in our portfolio may have approached us and said, look, let's look for a larger structure in which then this business can find a home, and how do we execute and make that happen. So really developing and cultivating a lot of those relationships has been a big focus over 2025. The fourth one is secondary funds. Again, on this piece, I think there are a few operators out of UK and the Middle East that are looking to do secondaries at a fund level, so at a portfolio level transactions. While we've done some exploratory work with these firms, we felt that the pricing was simply not optimal. And so we just did not really move forward with it, but we continue to engage with these parties as well, and that door remains open. The last one is the sale to private equity or corporate investors. But this is such a long sales cycle to get a business like this sold to a corporate. It takes a lot of time, and we hope that we will sell a few. We'll show you one that we did. We helped facilitate an introduction. But we think that this is still lagging, and this will develop over 2026 and 2027. So over the next 2 years, we think, as these markets mature, the exit pathways that are quote-unquote traditional in developed markets are still very much developing here. So when I speak to some of my counterparts in other countries, for them, exit management typically is maybe a smoother process. There are more brokers, more advisors, versus in our market, it just simply does not exist. So we've had to build that capability internally. So as Zach mentioned, we really try and manage our portfolio by creating a balance between liquidity today and then MOIC. So by remaining invested in the company, how much more could we earn over the next 2 years? Obviously, as we've tried to communicate to you, really we try and employ as much active exit management as possible. So working with our founders, finding the potential buyers ourselves, structuring the transaction ourselves, and coordinating the transaction ourselves. We try and take an active view to it. So I think some people might want to take pictures of this as well. These are the exits that we're closing at this time, and we can run through them. Some of you may have seen from the reports and from our last AGM, we sold our shares in GEM HR. This was about 1.5 years ago, with a MOIC of 1.2x, where the proceeds were $372,000. And this was for a full sale of our investment in the business. So we had done this transaction using the safe purchase agreement. So I wish that Simon was in the audience. He would tell you that it only took a week. So these processes are actually a lot smoother than when you actually own shares. The second exit that we had is on Kunda, a fintech business based in Tanzania, where we sold our shares as part of a funding round, a MOIC of 1.4x, and this fully closed. Thirdly, MAD, which is a distribution company based in Senegal. This, in fact, was our first exit officially as part of Fund 1, where we sold our safe note partially to a third incoming investor that at the time was trying to structure a pre-Series A round. So really a lot of creative solution to try and find liquidity for us. We only sold 30% of our $200,000 investment. That business now does about twice, I think 2x, maybe 3x the GMV that it used to when we had exited. We made a MOIC of 2.3 on this. We think by the time we exit the full position, we probably could get to a MOIC of 3.5 on a blended basis, of course. The fourth one to look at is Rubix. So Rubix is a fintech business based in Abidjan. This was sold to Cofina. Some of you may know the microfinance institution in West Africa. As part of that structure, we were able to secure a MOIC of 1.2x, and we obviously sold our shares fully divested from this investment. The fifth one is Resolute Robotics. So in South Africa, some of you may know this business, some of you who are based in South Africa. It's an edtech business helping schools bring robotics curriculum into the classroom. We have signed and completely closed the sale of 50% of our holding in Resolute for about, as you can see there, $215,000, which is on a MOIC basis 2.2x. We still remain invested for half of that. So this happened just before a funding round where they raised $1.5 million. So they have a lot of growth capital to grow that business even more. So we were expecting to see more returns on this business over the next 2 years, and hopefully we'll exit the remainder of our 50% of our shares. Just a note on the status of that. Exchange controls, which I think we'll talk about later on as part of this exit presentation, has been a challenge. So while we've closed the investment, since the buyer party is in South Africa, we've been managing some of the SARB processes required to repatriate those funds back into Mauritius. So we expect this to take another 4 to 6 weeks, but hopefully we'll close this as soon as possible. The 1, 2, 3, 4, 5. The sixth one is Complete Farmer, which is an agri-tech business based in Ghana. The business is really simple. They buy from smallholder farmers in Ghana and then export to, for example, Lidl in the UK and so on. So really, really interesting business. They closed a Series B round just now. And as part of that round, we're selling about 24% of our initial $300,000 investment. That generates proceeds of $245,000 on a MOIC of 3.3x. But essentially, this is about $1 million position in the portfolio, right? The buyer could not do a higher check size, and as a result, this is the transaction that we've secured. But we think the remainder of the $700,000 of shares that we have in the business are very easily marketable over the next year or a year and a half. As Zach mentioned earlier, we are in the midst of concluding, so the long-form documents are being reviewed as we speak to conclude a sale of our full position in Peach Payments. As I showed you earlier, this really is where we start to work on the larger positions in the portfolio. We're about $2.5 million on AfriX, $2.5 million on Nomubante, just dedicating a lot more resources over the year and a half to liquidate some of those positions. The last one we'd like to share on this is Be Free. So a secondary transaction where we're selling 41% of our exposure to the business. That generates about $500,000. The MOIC that we're earning on this investment is 2.5x, but really the business is on a trajectory that is exceptional. So we think on a blended basis, by the time we liquidate this position fully, we should be comfortably making around 3.5x to about 4x on the full position on a blended basis. So these are transactions where we have agreement from the buyers. We really are in the process of either transacting or working on SAR processes and so on. Our forward pipeline is also very, very healthy. So over H1 2026, we expect to close these ones. I know we say H1 2026, but in fact, we're signing the first one this week. So again, using a safe purchase agreement, we're selling 30% of our shares in Logidu, which is a logistics tech business based between Morocco, Egypt, Senegal, and Ivory Coast, so operations in multiple countries. We should be signing this very, very soon. And since it's a safe purchase agreement, the transaction moves a lot faster. So we should have these monies maybe by the end of the month. The second one to discuss on this slide is ePump. This is a hardware and IoT business that digitizes fuel stations in Nigeria. This was a very, very interesting target for an acquirer, and as a result, they are negotiating at this time to essentially acquire the entire company and consolidate. That should generate proceeds about $150,000 for us right now. It's not an exceptional return on it, but at least it's liquidity for the fund. We're signing this as we speak. The third one is Balad, the fintech business based in Egypt. They're entering into a commercial and an equity relationship with a listed company in Egypt. And as a part of that, we are liquidating our shares, so that should generate proceeds about $250,000. However, this is still a negotiation. So again, these are rough numbers that we just wanted to illustrate where we are with these exits. The fourth one here is Strove. So as Zach said, Strove, in fact, is one of our top performers. There is an opportunity in the making right now where the company wishes to buy back some of the shares. This, again, is very much pipeline, so we've not really accepted this. We're evaluating the offer internally on whether we should liquidate part of our shares and maybe come to generate proceeds that at least recover the face value of our investment while we remain invested for the remainder of our shares. We have not accepted it. It's still a negotiation. The next one to discuss is HappyPay. So HappyPay, a fintech business in South Africa. Some of you may be familiar with HappyPay. They're concluding a financing round right now. And as part of that, we are in discussions, and we've formally or informally agreed to the transaction. We have yet to paper it. where we're selling 50% of our shares to a co-investor. And that should generate proceeds of $200,000. We are just now finalizing a lot of the documents related to it and how we are going to get the funds back to Mauritius. And then the last three here are more forward pipeline that we want to share with you as to where we are, but these are still very early in the process. But I think it's important for us to show you a lot of the work happens by literally us meeting with investors and trying to structure some of these deals. So an example of this is we are working with a global healthcare fund that wishes to look at Launch Africa's top performing businesses. And so the business that we put forward was RxAll in Nigeria. We're considering the sale of around 40% of our total holding in this business, and that should generate around $400,000 in proceeds for Fund 1. The two last ones here, Zuri Health is a health tech business based in Kenya. We are considering a partial company buyback, and we're negotiating these last two. So we'll move on to exit strategies. And so really just the point to illustrate is, in terms of data that is available, there are about 70 total cash exits in Africa over 2024 and 2025. And if you look at the report, as we can see here, European venture funds from the 2020 vintage actually have almost no DPI. So what you'll see is the light blue one is European venture capital. Our American counterparts have some DPI, but really just a point to illustrate that we are actually leading the charge in Africa and structuring a lot of exits before kind of the end of the fund life. What are the lessons learned? So, as we said earlier, some of the challenges around exchange controls can take a lot of time. Not to single out South Africa, but it's just an example that we're dealing with right now. But a similar thing exists in, for example, the Waimu region. And so we're developing a lot of these capabilities internally on how do we do exits more efficiently as we go forward. So with that, I would like to pass to Florence, our head of platform and ops, to talk about how we do operations.
Thank you, Karthik. Hello, I'm Florence, the face behind, well, one of the faces behind the many emails that you receive. I'm head of platform and operations. What does that mean at Launch Africa? So operationally, that means everything that we do in the business. Platforms, that's everything we do for founders, how we add value to them. Operationally, we have had one priority this year, and that is cost optimization. So we have started in September. We had a 15% salary cut across the board for everybody, and that is still ongoing and will remain so until things improve for us. We have also not replaced team members as they have left. We have 2 people that have left, and instead, we have restructured the organization and upskilled other members of the team to take their places. We continue to build our brand, very important, looking forward, capital raising, exits, eyes on the prize, head above the water, spreading the word about the wonderful work that our team and our founders are doing. Founder platform. It's a much happier topic. So 2 years ago, I made a commitment here that we would reach an offering of over $1 million in credits for our founders. And I'm so delighted to be able to stand here today and say, not only have we met that, but we have exceeded it by 50%. And that is very much down to the incredibly hard work of my colleague, Jeffrey, who I can't see, but you will meet him throughout the week. Incredible work. So those partnerships, they're not only global tech partnerships like AWS and Google, they're also B2B sales partnerships, upskilling our founders and their teams, graphic designers, CRMs, all the things that our founders need to create and build great businesses. And I'd like to be really clear. The point of these credits is not so that they have a $1.5 million bill in year 2 when the credits run out. It's so that they're able to experiment and build and grow relationships with these service providers so that they themselves are building in an efficient way. We continue to have the biggest founder community on the continent, 250 plus founders. One of them smiling in the audience at the thought of that WhatsApp group. And for each of them to be able to have a direct line to someone who's already done what they're about to do before somewhere else, or solved that problem, and can be in touch with them within minutes, that is invaluable. And we consider Jeffrey, he's there behind the curtain. Jeffrey's work continues in the incredible workshops that we put on for our founders. Actually, one most recently by Sarah, which I use, all about grounding yourself and making sure that you're able to work. Again, keep your head above water, keep focused on the problems you're solving. Amazing coaching workshop from her. But we have other ones from Google, AWS, again, all about building efficiently, sales, all the things that our founders need to work on. And finally, we continue to have impact on the continent and in our portfolio companies above and beyond the capital that we invest in them. We have contributed to the creation of over 80,000 jobs. 72,000 of those, 72,000, that is such a huge number. 72,000 of those are gig jobs. And I'd like to add a caveat here, because gig jobs have a bad reputation in the global north. But here, to be able to gain employment and make a living for yourself and your family with very little education and skills, in a company like GoZem, that then builds you, allows you to upskill, facilitates that education of you, banks you with their wallet, that is the key to financial and social mobility, and that is true impact. And then finally, we have seen we know from a lot of research, both in our portfolio and studies done, that female representation on boards and organic adoption of governance policies within portfolio companies leads to increased revenue. So very happy to see that 28% of our portfolio companies in this last year have organically adopted governance. It's very important. We're not just telling them, you need a policy, then you'll make more money. So organic adoption of governance policies, and over 76% of our portfolio having female representation on boards. So with that, I'm going to hand over to Junaid to take us through the way forward.
So you can see I'm going to bring us back to this theme of surviving and thriving. This past 2 years has been a very interesting year. It's certainly, as an old traumatized investment banker, it's been trying, testing time for us. But we're still here. We're still having a thriving time leading the ecosystem. We've had to cut costs, as Florence mentioned, and we had to reprioritize staff roles and skills. But I think it has actually made us a stronger team. We've had to look at our tech stack, how we integrate AI, and I think it's actually made us a more efficient and more productive team. We continue to build our brand. We are invited to every conference. They even pay us to fly us there. And conferences can't have Launch Africa in the room. Doesn't seem credible then. So we are always building the brand in front of the audiences that matter. And we are looking for alternative income streams. We're constantly applying for grant capital to help add value to our portfolio, as our management fees are fairly limited to do all the work that we want to do. So today, really, as you saw by the amount of time that the speakers spent, today is about exits. And for us to continue building a strong exit ecosystem in Africa, Launch Africa is expected to bring the innovation. So we are thinking about the LASAR contract that we've introduced about 18 months ago. We are focusing on securitization or bundling of it and putting some theory, some frameworks in place so that other VCs can also duplicate that. We know from our experiences, as Zach and I know as fund managers, capital attracts capital, liquidity attracts more liquidity. And a lot of VC funds are looking to us to put those frameworks in place. We are now in year 5. Zach said we are very active in the next 2 years. But as Zach said, by the end of our new financial year in year 5, we'll return between 7 and 10%. Our goal by the end of this year, given that we've built these rails now, and given that this exit machine seems to be working, is to have at least 25% DPI at the end of this year. That's a big goal, given that, as you've learned, it takes 6 to 9 months to do an exit because of those dependencies. But we think that the pace will fasten for us, and we'll be able to do more exits as we bring more parties along with us in order to develop an exit community. But we also want to engage with you over the next 3 days and certainly over the next year as to what happens to the fund at the end of year 7. That's a conversation that we need to have. What we will probably do is set up a representative body, an LPAC, a Limited Partnered Advisory Committee, to get your inputs directly into how we structure ourselves outside of the end of the fund life. What that means is we're already considering certain options. We're thinking about just extending the fund life. We're also thinking about doing a continuation vehicle that needs to be capitalized. Just last week, the Financial Times wrote an article about how 80% of private equity funds that's the preferred approach. We would engage you if that's the preferred approach for Launch Africa Fund 1. We could also look at asset-by-asset sales. That would mean for us, set up a separate company, put all those assets into the company, and on a company-by-company basis, we'll exit those companies and return the capital to you. Or what has already happened is a lot of organizations like Seta Capital, NASDAQ Private Market, has approached us to buy our entire portfolio. But those interesting vulture-type organizations will offer you cents on the dollar. So we were offered 40 cents on the dollar, and we obviously refused because you want to do these transactions in an up market when you have more negotiating power. But that could be an option at the end of year 2. So these are the options that we are considering at our end of life of this current fund, which is only at the end of our financial year in year 7, which is in March of 2028. At the same time, we are growing as an organization. We have a new fund, but we still have to have revenue sustainability in our organization. So we are thinking continuously is how do we maintain a large team? We've got a very large portfolio. We've got an exceptionally large investor community of over 320 LPs around the world, 47 countries now. We have more than 250 founders. So we have a large community to manage a large portfolio, and we need a team sizable enough to manage that. But that requires revenue. So we have tested the waters, like most VC funds, especially in Africa, who runs accelerators as a supplement to their management fees. We tried this. It's very corporate dependent. So in 2025, we ran an accelerator for MTN in Nigeria. We hope that they will renew the contract, but it is very mandate-driven. It's very corporate-driven. One thing that seemed to have traction for us is that in countries, there are specific capital designated for countries only. And because we're a Pan-African fund, we've not been able to tap into those countries. So if we could manage capital on behalf of other bodies, that provides us for our ability to use our infrastructure, our Pan-African nature, and as well as our ability to build large communities as leverage in order for us to what we call our managed account strategy. 2 of those initiatives are moving at quite a pace. The one is in Botswana. Botswana is doing an early stage investment fund, and Launch Africa will be the fund manager to do all the fund administration processes for that. Secondly, the Francophone Africa, so the West African Development Bank, has approached us in order to conceptualize what a local currency fund would look like. A CFA fund, which would be to invest local currency into those, 8 Francophone African countries. These will be run by separate teams, so separate teams will be set up and our team will grow, but it will use the Launch Africa infrastructure, our tech stack, our centralized portfolio management, and our huge communities. And we think because unlike accelerators, which is corporate dependent, mandate dependent, and sort of a year-on-year chase, these are much longer, more sustainable revenues that we want to explore. So for us, we are surviving, but we're also thriving, and we think that continuing with this exit process and continuing to add value to our portfolio, working with our LPs in order to add value through your mentorship, through your corporate introduction, it will definitely be a great path to follow for the next 2 years. So that's the end of our presentation. Thank you for listening. Thank you for your continued support. And I'm going to hand over to Florence now to end the session.
Thank you. Junaid. We are going to now go to Q&A. So if I invite Zach, Junaid, Margaret, and Karthik on stage. Karthik, yes, you are invited, and you are correct in assuming there are a lot of exits questions. Audience, I would like to remind you that you can upvote questions that are in Slido. The presentation has disappeared, but it will be coming back. Here we go. So you can, if you're not in Slido right now, you can come back into Slido. Please do upvote questions because we don't have time for all of them, but I would love to know, for those of you online and here, which are the most important. So I'm just going to refresh and then ask the most upvoted one. Okay, so here we go. And any that we don't get on to answering today, we will answer in an email after next week, once the craziness of this week is finished. Okay, the votes are coming in. The companies which Launch Africa doesn't want to exit but has to, will they move into Launch Africa Seed Fund 2? If I can encourage you to be short on your answers, that's definitely a quick one.
Yeah. So our mandate does not allow for companies to move into the next fund. Why? We are trying to protect our investors, in fact, because it's then easy as a fund manager to manipulate the pricing, because we can set the price at the exit and then lowball the next investors to come into Seed Fund 2. And so we decided rather let's have a clear gate between Fund 1 and Fund 2. It also allows new companies access to capital. As I mentioned in the last slide, we'll rather find other mechanisms for us to continue adding value to those investments. But we certainly didn't want to be seen as price fixing between portfolios.
Wonderful. Why was a quintile 1 company like Peach Payments sold so early given their growth trajectory? Excellent question.
Yeah, it really is, again, that balance between MOIC and timing of liquidity, really. And I'll give you some more insight into that deal. In fact, we've actually taken no discount on that transaction. So we're selling at the current the highest traded price per share. So we're actually very proud of the fact that we were able to command a certain price. But again, you're only able to do that if the company has a lot of capital available to it. And we understand that it is a high performer, but again, some of the best exits that you get are on those high performers.
Yeah, I'll just add to whoever uploaded that question. So typically if a company is doing 5x or more, and Peach, we were doing 5x, the 4.5 is net of facilitation fees, legal, admin, and all of that. So it's typically a company like Peach we would not sell. So we have companies like AfriX, Yobante, Gozem that we're not selling. But at the same time, there is a subtle balance between getting some early liquidity. The second thing is we know the founders of Peach Payment exceptionally well. You'll actually meet one of them tomorrow at the panel sessions. And his candid offer to us was, we don't need a lot of capital. We just raised $30 million in our Series A. We have enough runway for at least 2 years. So our next round, our Series C, will likely only happen in 2028. So if you wanted to do an exit in the next 2 years, you've got to find the buyers, you've got to find the transactor, and that's not a risk we want to take on a quintile 1 asset. So therefore, making a 4.5x today, returning capital made sense, but it's an exception rather than the rule, if that makes sense.
Thank you. Could you please clarify what was said about the expected March 2026 distribution? Is it 7 to 10% of the total or of the invested capital?
Total capital. So the $36.2 million, so 8 to 10% of that. So it would be between 2.8 to 3.6 million by the end of March. Yeah.
So although the capital that was invested was only 31 million, because we obviously take our management fees over the life of the fund, our returns is still calculated on the total value, the total capital that was invested into the fund.
Regarding company sales to platform aggregators, are we seeing or will we see PE players come to the African market to consolidate sectors similar to the US?
So as much work as we do on the exit side, which is speaking with a lot of these profiles globally on the private equity side as well, I think there's in general a level of interest. Are they transacting on it today? Maybe perhaps not as actively as we would like them to, but we expect that to happen over the next 2 years, and we're positioned uniquely to be able to sell them some of those assets if and when they choose to do so. For example, I think one of the very interesting things to do could be a health tech roll-up strategy, because we are exposed to health tech businesses in so many different markets. There's opportunity to do so in logistics as well. And so we're very, very open to working with partners that would like to pursue that with us.
So it happens on a sector basis and a regional basis. So we had a large private equity fund in Nigeria say that we have no exposure to tech whatsoever. So could you look at bundling all your Nigerian companies, irrespective of sector, and packaging it for us? And that's a conversation we're having, and it's ongoing.
I could just add to that too, because I have those ongoing conversations with UK and GCC PE funds. We're just too small at this point in time, but certainly in the next 3 to 5 years it'll happen.
Have you thought of creating secondary funds for yourself and other VCs? I can actually answer that. Part of that is that yes, both the Botswana Tech Fund and the Francophone Fund, the WEMU Fund, will both have a secondary mandate.
We are constantly evaluating what we've done, but right now, for the past 2 years, we've decided that exits for Fund 1 and capital raising Fund 2 should be the priorities. So outside of those 2 opportunities in the accelerator, we get approached to do many things, but it's important, because we're a small team, to keep our head down and to survive. And for that, it meant exits from Fund 1 and capital raising for Fund 2.
Okay, time for one final question before we break for refreshments. How can portfolio companies be of service to you beyond generating returns? Which is a great question. Villani, was that you? Yeah.
Well, we've already had examples of portfolio companies introducing us to investors and follow-on investors, like fund investors. I think the other thing that portfolio companies are really good at doing is attracting more talent to the VC ecosystem, including our Launch Africa companies. I'm really proud and excited about that.
And I'll just add, if you noticed Margaret's slide on how evolutions of other ecosystems develop, a critical part of that was that first and second time founders then start investing into funds and vehicles that then invest into the next generation. So we've always thought that our 200, 300 LP founders should give us $1,000 each, and that would start generating, because once you're an investor, your pocket talks, and you will then start mentoring others. And it's this ecosystem wheel that we want to create, Villani. So talk to us about being an investor in Fund 2.
And finally, also by working together. WorkPay is an HR platform that many of our portfolio companies use. Be Free is also used by many of our fintech companies as well for debt collection. We're going to end there. Thank you very much for your attention. There will be time for more questions later. Please help yourself to some tea and coffee outside. For those of you who have not yet decided to invest in Fund 2, we say thank you and we will see you later for dinner at The Athletic. And for those of you who have invested in Fund 2, we will see you back here in 10 minutes for the Fund 2 AGM. Thank you very much.